And welcome in our credit market outlook panel this afternoon. We're going to get a tremendous opportunity to travel around the world. And we're going to start in the United States. Only one of our panelists lives in the United States, though everyone has offices in the United States. So Lawrence, I'd like to start with you. And one of the things that we haven't really had a chance to reflect on in some of our other sessions has been the enormous change in the United States in the middle market area. And so when you think about the growth of the public markets, private markets, et cetera, and job creation, if we took a look at job creation in, say, the last 30 years of the 20th century in the United States, and creation of almost 60 million jobs, you will see that in small and medium companies, 62 million jobs were created over that 30-year period in the private sector, whereas your larger companies created minus 4 million jobs. And if you look at the trajectory here, you can see up until around mid-70s, the small and medium companies were growing at pretty much the same level as large companies in terms of job creation. But after what occurred in 1974, 5, 6, access to capital, small and medium companies began, and it was very difficult for larger companies to compete once talented entrepreneurs forming new businesses, et cetera, had the same leveling field. And by the early 1980s, 1981, 1982, but definitely by 83, the market was fully open and dramatic changes occurred in who was creating jobs. And so the importance of access to capital, whether it's in China, whether it's in the United States, to small and medium companies, has been essential in the growth of jobs in a country and an economy. So Lawrence, talk to us a little bit about the changes that have occurred over the years in access to capital and small, medium business, the somewhat withdrawal of the major banks, and how you use that to build Golub Capital.
Sure, Mike, thanks. And thanks for having us here this year at your conference. The U.S. middle market, if you look at it on a standalone basis, would be the third largest economy in the world. It's vibrant, fast-growing. We're lenders. We lend to the U.S. middle market. We track pretty carefully an index of performance and growth and revenue, growth and profit. U.S. middle market companies that are private equity backed have been growing consistently faster than U.S. GDP and consistently faster than publicly held companies by about 400 basis points. And with the private equity industry having grown the way Mike describes, the number of private equity-backed companies in the United States vastly exceeds the number of public companies. Most of these private equity-backed companies are middle market firms, EBITDA between $10 and $100 million per year. Banks do not really serve the middle market private equity-backed companies. Bank lending accounts for about 12% to 15% of total lending to the private equity universe. And this predates Dodd-Frank and the regulatory framework that was introduced as part of the financial crisis. A question we get very often is, with the Trump administration's potential relaxation of financial regulation, will banks become more active in the United States? And the reality is banks don't have the infrastructure to do it. They don't have the team to do enterprise value lending. They don't have the compensation structures. The flexibility in terms of both debt and equity capital that's available to medium-sized businesses is why more than half of job growth in the United States comes from those companies.
So this is not unique. We can see in other parts of the world. So Pierre, let's take us to Europe. And we see in Europe, the UK, probably after the United States, moved second in focusing on creating capital markets. But it has a long way to go. And if we looked at, say, the concentration in Europe versus the United States, we still have Europe today still dominated by a bank financing system. And loans in Europe substantially more held by banks than they would be in comparison to the United States. So Talk to us a little bit about Europe and the opportunities for financing in Europe.
Sure. So first thing, maybe just on the environment. I think we heard this morning people talking about the environment being interesting. I'd argue it's interesting, but it's also complicated. I think we've seen bank retrenchments. We've also seen crowding out of the market by central banks. And that's partly contributed to record low rates, spreads, and yields, but also record low volatility and minimal dispersion. So it's an environment, especially ahead of, not calling out rates, but over the next couple of years, potentially seeing rates and central banks starting unwinding their balance sheets. We want to be defensively positioned and making sure we focus on really margin of safety. I think when we focus on the bank retrenchment, frankly, over the last 10 to 15 years in Europe, we've seen already a market that's doubled in size, and where it used to be maybe 70 to 80% bank focus, and within that 70 to 80% of the bank term loan, it used to be really mostly held by banks. We've seen that market now double in size, and we've seen a lot more high yield issuance. But even within the term loan space, there's been also a lot of new actors, whether it's CLOs, whether it's some loan funds. And from our perspective, that's created a lot more source of opportunities, but also it's created deeper and broader markets. So from our perspective, there is a lot more opportunities to look at. And we expect that trend to continue, and we think it's probably a trend that we'll see develop across Europe and presumably as well in Asia.
Talk to us about culture. You're European, today working in London. You have a company headquartered, GoldenTree in New York. How does that culture work? How do you interact with them?
Sure, I think so if I look at what's been the driver of success, I think for us in Europe, I think I'd say three things. I think first, it's been about developing that local knowledge and expertise. It's been about using the same disciplined investment process, and it's been about having a global relative value framework. So if I think about the first of those, the local aspect, I think GoldenTree has been invested in Europe since inception of the firm. We focused in the early 2000s around some of the German distressed cable names. We've opened an office in 2005, which is when I joined the firm, and we now have 20 investment professionals across industry experts, restructuring experts, traders, sourcing, and business developments. Most of those people will come from the various European regions, speak the languages, understand the culture. And not only that, but the restructuring experts we have, those are people who've been trained in navigating restructuring process across the UK and Germany, but also Spain, Italy, Greece, which I think is critical. So developing that local expertise, that local knowledge is something that's very important. The second aspect is around that investment process and being very disciplined. I think everybody at GoldenTree will use the same investment process, whether they're based in New York, whether they're based in London, whether they look at structured credits, corporate credits, or emerging markets. And I think that's a process that's very much focused on fundamental work, looking at margin of safety, direction of earnings, and total return. And it's also a process that's very collaborative. So I think we've been fairly active in directories, which has been a challenge structurally and challenge the sector. And over the last 5 years, we've invested over $1 billion, generating 30% return on assets. And that's been an investment which has been driven by some collaboration between the guys in New York and us in London, trying to leverage some of those experiences we've seen. The last aspect is around that global relative value framework, where we don't wake up one morning and say we want to have 20% in Europe and 15% in Asia. Every single security in our portfolio is something that's accretive to the portfolio in relation to its own specific merits. And that's merits focusing on the fundamentals, so direction of earnings, margin of safety, total return, but also focusing on the jurisdictions where we operate. So if we look at our distressed investments in Italy, we can have different expectations than if we look at our distressed investments in the US, for example.
All right, let's go to a person that lives here in the great country of Singapore in perspective. So Ilfryn, you've moved to Singapore. You're interacting with your partners all over the world. Those in New York, you have a 12-hour difference from. Minneapolis, you have, depending on the time, you have 11 to 13. Let's talk about first how that works and how your decision to come to Singapore was, and how you get a different global picture by being here. I know you have a number of offices around the world.
Yeah, and I was lucky enough to spend nearly 11 years in our London office before this, and so I've seen a little bit how we go about building a global business. And I think that's the heart of of the answer to your question, really, is I think you can't do this properly unless the firm commits to it. And we've seen through the history of developing our business around the world, we're about to open our 13th office, I think is the right count, that it really requires that commitment from the firm to putting the culture of the firm, not just the investing culture, but the human culture into each office, and to dedicating to making each new move successful. And so if you think about how we've approached it, I mean, we opened our presence in London in 2004. Partners and founders of the firm moved there to open that office. So we both built it up as part of the Värde network and then built up the local expertise in that market. I think a number of the things Pierre said are very resonant there. You have to have both that culture of the firm and you have to have also the local knowledge in every market that you're in. And for me coming here, I mean, I don't think we have to be geniuses to work out that a lot is going to go on in Asia, and it's a growth market. It's an opportunity for everything we do across alternatives and credit. And that's really the long-term prize of what we're all trying to build here. I think that's very exciting for the long-term future of our firm. It's very exciting for me personally, having lived through building our business in Europe and now seeing that opportunity to do it again in Asia. And the interaction, you do a lot more late nights here. You do a lot of conference calls, not so much to fit in the Minneapolis or New York angle, because that's manageable, but to fit in the global angle. And we take very seriously the relative value of what we're doing across the firm, the idea sharing of what we're doing across the firm. And so actually I blame London a little bit more, because if you just have to have the US, you can manage that. If you have to have all three big geographies of ours, it's more difficult, because you look at those calendars and you say, well, it probably makes sense for me to suck it up.
So take us back. You've come from London to Singapore. What surprised you, if anything, about looking at credit from Singapore versus London?
I wouldn't say there's any major surprises. I think there's a lot of memories. I think what you look at in many of the markets here is quite similar to the evolution of how Europe has moved over the last decade. And those of us who were there doing stressed and distressed credit in the 2004, 5, 6 period of time, I think there's a lot of that market development and that sophistication around how to think about credit process that will move over into this market. The thing that you have here really in Asia that you have less so in Europe, and I don't want to offend any of my European panelists, but this is a market that at the end of that process and the process of credit creation and what's a deleveraging process now in Europe is going to grow and grow and grow and have demand for more credit. Whereas in Europe, you could argue, well, once you get through this phase of credit markets sorting themselves out, you might be on more of a sideways path. And so I think that's, that really is the key to Asia, is the growth that's going to continue to come and the demand for capital that's going to continue to come here.
We often talk about this concept of social capital, and what is social capital? And why would you invest in a particular country around the world? So one of the areas is rule of law. What is the protection for creditors? In some Asian countries, 20 years ago, if you defaulted, the person running the business had another 7 to 10 years to decide what to do. It's questionable what the creditor rights were to encourage people to invest. Now, Rob, your firm is really focused on Asia and investing in Asia. So if we take back and look at that list of elements of social capital, as you're thinking of the different countries throughout Asia in terms of rule of law, property rights, creditors' rights, etc., financial reporting standards, maybe give us a view as how your firm is looking today at Asia, different countries in Asia, and how do you approach investing in credit?
Thank you, Mike. And Clearwater Capital is proudly a dedicated to Asia-only investment firm. And we were founded 16 years ago, really, if I may say, out of the ashes of the Asia financial crisis. Fact, mostly unknown, every single Asian country, period, changed their bankruptcy law after the Asia financial crisis. So that means through whatever domestic legislation process they had, they all changed their law. So people in the West typically start a question of Asia with this, and it is core, it is fundamental. But what is under-recognized, and still the opportunity in Asia, is Asian creditor rights are far better than perceptions, even today, 20 years later, they are. Where are they good and where are they bad? North Asia is outstanding. Korea has led, right? China is better than it's perceived. India has done it. And here in Singapore, just recently, as you may have followed, they've actually updated and amended their restructuring rights as another great example of not only having changed their bankruptcy code originally, but having updated it today to be very similar to what's happening in Chapter 11. So sort of the restructuring hub of Asia with new bankruptcy laws and examples here in Asia. So not only have they changed over the past 20 years, but they're practicing. There are great creditor experiences through Asia, frankly, because of the tough times that Asia has won by. So it's not just the Western view that did this. Why did bankruptcy codes change? Because the banking system in every one of these countries needed it. So in China, when all the banks went public, when the asset management companies now 12 years ago were established with 10% of non-performing loans for every bank dumped in, everybody said, how can you take these companies public? And now today, all the Chinese banking systems trade at premiums to book, well, maybe not all today, but certainly have over time because the law works. And they changed it not because Western people came in and said they said, because it's logical and the anchor of their banking system. Finally, India. Right now, India is going through a notable evolution and very, very painful non-performing loan example, 15% of banking system. And they're doing it again. The RBI, the new bankruptcy code, is another great example. So this is today's reality. For 20 years, Asia has changed their bankruptcy code. It's a $50 trillion market. But the point is, this panel is an example. Asia has gone, and we are right at the forefront of it, from a nice-to-have niche to a must-have core. $50 trillion of credit. And as you see, really, the leaders of credit in this room here, in various permutations today, in your earlier panel, we're in Asia. Milken is now in Asia because it's a must-have core component of your portfolio, no longer with better creditor rights than most of you think.
So I think this is a challenge, and as I'm going to move in a minute here to Hamilton Lane, Juan, and talking about it, I just want to comment that this issue of creditor rights is core, but it's both sides. Rob, when you think about it, you can't encourage me to be a creditor unless I have property rights, creditor rights, et cetera, or that I can believe your financial reporting. In the crisis in Greece and Europe, we and others particularly were focused on Greek bonds issued under British law. Because bonds issued under Greek law, you could decide changes could occur. You might take a look at the example of Hungary, where they had a mortgage market where you could borrow in local currency or Swiss francs. Well, when the Swiss francs went way up and their currency went way down, you now owe $2 for every one you borrowed. The Supreme Court in Hungary had a ruling that you could pay back in the same exchange ratio you borrowed at, obviously inflicting enormous pain on Swiss investors or those that have bought in Swiss francs. And so one of the keys is the confidence in the government, rule of law, creditor rights, et cetera. So Juan, I'd like to start from the standpoint, our global capital markets group that has 4 meetings physically a year, 1 here in Singapore, has about 330 members. They have in excess of 20 trillion in assets, and about 160 of them are here in Singapore, many of them at this program today. Let's talk for a few minutes about the multifaceted Hamilton Lane and what services you offer.
Right. Thank you, Mike, for inviting us. You may wonder, what are we doing? What am I doing in this panel? We are known for one thing, less known for others. We are well known, I believe, as the largest advisor in private markets, which we do with pride, and we've been doing since 1991. We advise today about $320 billion, which is not a big deal if you are in public capital markets, but in private markets, it is a big deal. That probably makes us one of the largest allocators of private markets capital in the world. Perhaps less known is that we can help you invest your money. So we manage money. We have $42 billion under management. And so if you're a family or an endowment or a pension fund and you want to outsource all or part of your program, that's why we have a business. You typically outsource to us what's hard. It's obviously the case that you do as much as you can in-house, and we can maybe talk about that balance later on. And the one thing that might be less known even is that we are a direct investor. We are a lender ourselves. So we have, over the last 5 years or so, started to be a mid-market lender with our partners in a co-investment, debt co-investment fashion in the US, as well as on an opportunistic basis in Europe and in Asia. So that's our business. I take it as a compliment, the multifaceted thing. It shouldn't be too complex, by the way, without, at the risk of sounding like I'm selling securities, which I can't. We're listed. So you can just, I think nowadays you have more transparency into Hamilton Lane than ever before and that you have in any of our competitors. But maybe one of the other reasons why I'm here is because the credit story is a tremendous part of the growth in private markets. So it's not about private equity. A number of times in the conference you refer to private equity and everyone goes to the buyout world. If you look at the fundraising statistics, the biggest winner, relatively speaking, over the last 5 years is private credit. And a number of my fellow panelists are the managers we work with, and a number of them had different vehicles. But if you aggregate again those statistics, you will see that the buyout world has been relatively flattish over the last 5 years or so.
Why don't you talk us through this?
But on this one, I think to me this is one of the, I mean, $100 billion, $120 billion on a run rate of fundraising, again, is not a big deal compared to the leveraged loan market overall. But the trend is very clearly one of huge growth. And that is why I think you have a private credit panel and a private credit discussion. Interestingly as well, I would point out 2 strategies dominate. And it's interesting for many reasons because it's a bit of a straddle on the cycle, distressed and mezzanine, right? So the direct lending and the senior debt piece is a relatively newer arrival, and it's a fast-growing one in terms of the percentage of the fundraising. And if you look at the AUM side now, so that's what's coming, you will say, right? That comes into blind pool vehicles, will be invested over the next 3 to 5 years. What's on the ground? Kind of a bit of a similar story, but here you see more of the direct lending. So this is what you own. If you own the market in private markets, in private credit, this is your portfolio. The part of why we are in even our own growth is driven by this. We've advised on $15 billion worth of credit, and we manage $4 billion worth of assets under management in credit ourselves. So the numbers have grown exponentially, much more so than in buyouts, growth, all the other strategies. We used to see, you know, I remember when I met Rob, right, in Philadelphia 13, 14 years ago. He was a giant out here. Who else was doing credit out here? On a run rate basis, even 4 years ago, we were seeing only the firm about 90 funds a year. Today, we see over 140, just credit, just credit. It's the fastest growing area where we need to answer to our clients and help them build portfolios.
So I think one of the things that underlines a movement that really began in 1974-5 in the United States has been this movement to explosion of organizations that have been trained, staffed to do research and provide credit in public and private markets. So Lawrence, let's go back to yourself for a moment here. We've heard a lot about the opportunities in Asia, but when you think that the middle market in the United States would be the 3rd largest economy in the world, there's plenty of opportunities today for expansion for yourself in the United States. I know that. So someone says, well, how do you even go in the business of making middle market loans? Could you just walk through the process and what you've built at Golub Capital over the years to service this market?
Happy to. I think the overlay is that direct lending, if you do it at scale, is an operating business. It's not a fund. You need to work and provide solutions to private equity firms. You know, in our case, we've closed transactions with over 200 private equity firms. 75% of our business is repeat business with companies owned by the same private equity firms. These are very demanding clients, very demanding borrowers. If you're not helping them increase their success, if all you're doing is providing money, you're going to get left behind. So the infrastructure you need starts with people. It starts with deal makers who are really skilled at deal engineering, not financial engineering in the sense of synthetic CDOs, but people who are able to look at prospective scenarios for how a company is going to operate, what sort of growth plan and margin of safety is required, and can really help the private equity firms increase their chance for success. Now, that is much more complex than being a desk buyer of a security that an investment bank creates, but it's only a starting point. Let's go to the next slide, please. We have over 350 employees. Absolutely, we have 120 or so investment professionals, but a majority of our employees work in the middle and in the back office. Firms like ours have replaced banks as providers of capital, but no one can replace the mechanics that go behind it. We have hundreds of thousands of accountant postings per year. We have 100 people who work in loan operations, fulfilling revolvers, who are monitoring covenants, separate and apart from the portfolio management and workout kinds of functions. Technology is a very important part of our business. We have 35 people who work in our technology department, which sometimes shocks me because I remember much of the firm's history, we didn't have 35 people. The business I started the business about 23 years ago, and we've grown very gradually. It is separate and apart from underwriting to not lose money, and absolutely the rule of law and bankruptcies or security you get from that is very important. In the US, actually the best thing though is to just avoid bankruptcies altogether. And growing and building this infrastructure as the market has matured is all centered on reliability. Reliability to your investors, reliability to the SEC, reliability to the private equity firms who come to you.
So we've talked now about, in absolute dollars terms, the largest economy and the driver of this middle market opportunity. And also you can see here the combination of this growth in private equity. So for every dollar in private equity, we're looking at $2 to $3 in credit from that standpoint, and the groups that service it. Let's take a look at the second largest economy in the world, China, for a moment, if we can pull up slide 37, and let's shift again to Asia. So if we look at this situation, we have large enterprises still receiving by far the most in terms of financing in China, whereas a very large percentage of all the employees are in smaller companies and medium companies. And if it evolves similar to other countries, you're going to see an increase in the percentage of employees. And so whereas 88% of the companies in China would be small and medium, they're only receiving 24% of the debt. And so when we look at these areas, maybe we could just touch base, each of the panelists, on what is the opportunity, what do you see the changes occurring here in Asia?
I really think that question epitomizes lending in Asia, because one of the things you have here in a way that's a little bit unique is entrepreneurs who expect to earn very interesting returns on their equity, but don't have access to capital. And so there's a variety of different ways of bridging that gap, but the way we provide solutions through our capital is a key component to that in a number of markets. I think it will be key in China, it's certainly key in India and Indonesia. And I would pick up on a point that Lawrence made. You know, I think in each of those cases, it's important not to just identify that there's that demand for capital, but to go there and do it properly with your own institutional infrastructure, but also with local infrastructure on the ground, whether you rent that or own it or put it there yourself. And so I think it's, you know, in a way, when we look around all of the lending businesses that we have around the globe, there's two big forces. There's one is the retrenchment of the traditional banking system, and we've seen that. We have a slide in here that shows just in developed economies, that's about a $6 trillion opportunity. We talk about very big numbers in this space, obviously. But when you look here, not only do you have that bank retrenchment force, which is really a global force, you also have that growth capital and financing of entrepreneurs earning interesting returns. And it's true in a lot of these different Asian markets. I think it's really one of the more unique things about Asian lending.
Rob, you want to comment on that?
You know, I think across this panel, we've touched on many of the things that are happening in Asia, and I might, start with what Lawrence is saying and what Lawrence has built as a non-bank leading lender in the Asia market. It really is, sort of falls within that direct lending bucket that Juan referred to. And clearly, as you look at what is changing and happening today in Asia, and maybe it's worth looking at back to your slide 37, non-bank lending is absolutely and unequivocally happening across China. And why is it happening across China, and frankly, a host of other markets? Because the Chinese regulators need it, and the consumers need capital. So if you look at this chart, what is the obvious conclusion here? In China today, they are doing and will continue to do exactly what Golub Capital has done in the US market. We have two partnerships in China, one along with Huarong, which is a $4 billion balance sheet doing non-bank lending in China, and one exclusively with our LPs. It's a controlled direct lending business, you know, doing middle market lending out of the city of Chongqing, 27 people doing that. And a third example, and frankly a great partnership example, together with our friends at Värde in India, we've built a non-bank direct lending business in India as well. So the non-bank lending theme that is so obvious and makes so much sense to get capital to consumers, to get capital to small businesses, is taking place, though frankly early stages to what you've built in the US.
Juan?
And just from the investor perspective, so we have been privy to some of those discussions and entirely subscribe to them, but it's very hard in credit in Asia in particular. Many times there is a thesis up here, the macro, and it's very hard to get past it in US investment committees and in for some of the CIOs, some of you in the room. And so there is clearly a lack of capital for that investment thesis, and yet there's too much capital ready at any beck and call for distress in China, right? NPLs in China, who has them? We'll buy them all. Well, you buy them all. There's a lot of that expectation in some subsegments of credit, and there is unfortunately a scarcity of capital. Not unfortunately for these two entities, but I think more of that is needed really. And India and China are two very great examples where we have played that. But the other thing I'm sure you'll comment on is that changes dramatically as you move in different countries, right? So that is only good for those two places.
So let's turn the tide just for a moment and understand how this plays with government. So if we start in the United States, the government would rather have less bank exposure. So we have non-bank, not guaranteed by government or insured after 2008, take on liabilities and shrink the banks. That would be totally aligned with government, whether it's in the U.S. House of Representatives or Senate. They'd like to reduce the exposure of government guarantees. Let's go, if we could, just for a moment here and talk about France, Pierre. And what we've seen to a certain degree is the banks have movement to shrink has been substantially slower than anyone would have thought. And so realizing the challenges that the banking system is so large relative to the economy. If we go back and look at Ireland, for example, the facts were that the banks lost as much as the entire GDP by their loans, which is the challenge. So it wasn't the government system, it wasn't the industry, it was the fact that they were so large relative to the size of the Irish economy. Why do you think it's been so slow? It's not that you and other firms like you don't understand the technology, don't understand how you could finance companies, structure, Private equity is talking to you all the time. Why do you believe it's moved so slow in Europe relative to what some people thought would occur?
So firstly, I think I'm glad that it's a question about the banking system. For a long time being French, you had a question about the politics, but that's a welcome change. So I think, clearly the banks remain very critical and important in Europe, especially in France. I think we've started to see a change, though. If you look at with the arriving of material amount of private equity money, if you look 10 years ago, again, I think the banks were probably 80% of the total markets, and within that 80%, it was probably 80% owned and by banks, which were in trading. So I think we've seen, if you look at the new issue over the last 10 years, we've seen probably that shift away towards a lot more the high yield markets, and even within the banking system, the term loan, I think there's a lot of different players. So I think we started to see a gradual shift, and I think, frankly, it's helpful because it helps us as credit investors source more products. It makes deeper and broader markets. But I think it's also helpful for the companies themselves because I think it helps bring cost of capital lower. From our perspective, it doesn't mean that the valuation, though, given we're in the cycle and we talked about the market being at a complicated inflection points, which we like to think in terms of sort of mid-cycle risks and mid-cycle pricing and late-cycle risks. But I think, frankly, that increase in supply is something, whereas we don't necessarily think it's attractive right now. When the volatility comes back, potentially on the back of rates moving higher, will create a lot of opportunities for funds such like ourselves.
Okay, so I'd like to switch, maybe just get quick responses in one area, and that's currency. Over the last decade, we've seen dramatic volatility in currency. The British pound falling 10% in a couple days, for example, would have been unheard of in another period of time. And so the currencies of Asia, if we look at Asia today, have a great deal of volatility. So if you're managing money at Värde Partners, what is your benchmark? What currency are you being benchmarked in, and what are your investors looking for?
I would say, as a general rule, we're benchmarking back to US dollars, and our investors are looking for US dollars. I think the thing that we think about a lot, though, is in these local markets, how to access the liquidity that's onshore. And so we'll often structure an investment such that we own the infrastructure in the country and can access the liquidity in local currencies and maybe hedge our equity investment into that investment. And we have a group of folks at Värde who focus on those sorts of risks, specifically with some individuals who focus on the hedging of more complicated currencies. And so as we get into places like India or Indonesia, that group comes into its own.
So you can just see here from the charts we've put up that show the volatility of different currencies versus the US dollar. What about GoldenTree? How are you indexed?
Well, I think we also look back to dollars. I think we look, obviously we hedge back to dollars, but I think we also look at currencies as a way to create interesting optionality. And I think one of the theme that was interesting for us last year in Europe is we were looking at spreads that were for senior secured risk around 500 basis points, which we felt with good margin of safety going in the right direction was relatively attractive. I think what made it special, though, is at the time the shape of the cross-currency curve meant we were able to not only pick up when we hedge back to dollars, the pickup in rates, but also an extra 80 basis points. So if we looked at that European senior secured risk, which at the time was trading at 5%, if you hedge that back into dollars, you're actually getting 8% piece of paper, which we felt was very attractive and made duration really attractive in Europe at the time.
Well, it's interesting, just to touch on Europe. When a company used to finance that had international operations, they generally paid a premium to borrow in euros versus dollars. Now, in non-investment grade debt, you could see 2% lower rate in Europe versus the US. How do you approach that?
So I think for us, we very much look back and dollar adjusted yields. And I think that cross-currency swap last year was probably as wide as like on the 7 years, 80 basis points. It's probably back at 40 basis points. But I think we very much manage that relationship. I think, frankly, for investors like us, such as ourselves, it's probably been more interesting to buy European spread and hedge that back into dollars. And frankly, it should have been the same for issuers. However, we've seen a number of US corporates they like the headline lower coupon. And I think we've seen a lot of US companies reached out and issue in the euro market.
Well, once Unilever borrowed at 0 for 5 years, it gave us an indication. Juan, how do you look at it both from representing LPs, versus where you've invested directly. How do you deal with currency volatility, and what are you seeing?
It's funny that you're seldom asked this question in Europe, and I travel to Europe, and that is the only currency where we've made money on the hedge in the euro dollar. We're dollars. And then I get this question all the time by investors when we discuss Brazil. We showed at the bottom of your chart, and everyone's front of mind is how do you hedge a currency. So most of our clients have currency overlays at the portfolio level, so they really do not want, in general, they do not want the private market managers to be engaged in active hedging unless they have an expertise, a proven expertise doing that. So just remember that. It sounds very, and not just because I said it, because that's what the underlying clients really, really would tell you. So please don't play that if you're not good at it. I can hire a currency manager at the portfolio level, bigger numbers, I can take different positions. You're just too small, just move on. I want to measure in dollars. But I do think that in some situations in Asia, it's just overblown. I mean, we've done well in India, credit and special ops investing with our partners, and we were currency hedge. And that's been a good experience. We can't afford to hedge in Indonesia, or we wouldn't really worry about hedging in Korea or Japan, right?
So, Rob, do you want to comment on that?
Just quickly, 80% of our portfolio today, we're dollar guys. In Fund 4, 80% dollar-denominated instruments. Or, today in Fund 5, 100%, right? So you can do a lot in dollars. Now, we do take in our co-investment vehicles local currency. And I would just correct the fact, 2016, Asia, using RMB and Korean won and the major currencies, less volatile than the euro. So Asia is actually not as volatile as its historic reputation, and it's important to differentiate the big economies from the smaller economies. India is the expensive one to hedge, but actually the RMB has a great forward curve, the Korean won has a great forward curve, the yen has a great forward curve. So you can do plenty of credit, and there's plenty of yield differential, 200 basis points in China, 400 or 500 basis points more in India, and just take out the currency risk. So it is less volatile than people think, but frankly, we can invest in dollars and get dollarized returns.
All right, let me shift to actuarial assumptions and pension funds, if I could, for a moment. So one of the challenges and one of the great responsibilities that each of you and your firms have is to generate rates of return that allow pension funds, endowments, to meet their obligations in the future. Today, we have, if you look at just the largest companies in the United States, hundreds of billions of unfunded pensions that exist, and that is with actual assumptions that run as high as 7.5% or even 8%. And so as we look at the United States today, you still have very high relative actual assumptions. So when you think of those unfunded pension liabilities and the idea that someone has a 7%, 7.5% today actual assumption, there are a lot of challenges. Juxtapose Japan, where actual assumptions generally are around 2% today as what the rate of return, or Canada, where you generally find them between 4 and 5%. And so much of the stability of the world to fulfill past commitments to be made lies in the hands of money managers today to try to achieve those rates of return. And what we see in talking to our capital markets group, if someone actually thought you could produce 8%, you might get $1 trillion. So Lawrence, are you ready for $1 trillion, and can you produce 8%?
I can produce 8%. I can't produce 8% with $1 trillion. And one of the things we see in the market environment today, if you look at credit risk, you look at not just the current yield, but the risk that there'll be credit losses that are material enough to impact total return over the life of investments, with leverage ratios back to where they were before the financial crisis. So you can see in both high yield and senior debt, spreads have come in, high yield practically at all-time lows, leverage at 5 times, which is the reported statistic, but when you actually look at the highest quality companies private equity firms are buying, they're paying 12, 13, 14 times and trying to borrow 6 times, 6.5 times EBITDA. We're very concerned that this reach for yield, which is driven in part by the actuarial assumptions, is causing an unsustainable level, especially in junior debt, an unsustainable level of credit risk. Junior debt on a relative risk, relative return basis compared to other asset classes look good. But in the long run, as a credit investor, you have to look at absolute risk and absolute return, not relative return.
So I think one of the areas in looking at that chart we should definitely touch on are covenants, maintenance covenants. And so when you talk about leverage ratios being back at levels that are higher than they were during the financial crisis, I think when I think back my own experience running almost 50 years, I cannot think of a period of time that you had less covenant protection.
Well, that's exactly right. I mean, the primary difference between, in the United States, middle market direct lending and broadly syndicated direct lending is in the broadly syndicated market, there are no maintenance covenants. And what that means is, as a senior lender to a company that is borrowing through the broadly syndicated loan market, you have no seat at the table till the company literally runs out of cash and can't make its interest payments. It's much harder to fix a problem when you're already teetering over the cliff. In middle market companies, covenants have gotten looser, and some lenders are playing around with the definition of EBITDA. EBITDA isn't EBITDA anymore. It's pro forma adjusted for growth and cost expenditures that we promised to identify within 12 months in our reasonable judgment. We try very hard to stay disciplined on that, because in our business, the key to our making the 8% or 9% or 10% is having very low credit losses, which depends on much earlier intervention. We'll see how this plays out, in this cycle. There will be another cycle. Everything we see in the borrowers indicates that the economy in the US is perfectly healthy and growth is continuing. So we're not seeing any warning signs in terms of the intrinsic performance of companies, only warning signs in terms of the credit risks.
Rob, do you want to touch base on this challenge of rate of return?
Asia is becoming core, not niche, precisely because of this. Simple interest rate differentials make sense here in what are very large economies, the second biggest economy. So it naturally draws you because of absolute rate of return, and people have simply done their homework that you can have rule of law and the like. And we believe you can build risk-adjusted, dollarized portfolios with 200 to 300 basis points more with exactly the same risk profile, or arguably, in many cases, better risk profile. So, it is drawn capital to Asia. Frankly, it's still early days, but there is real opportunities to build a portfolio that's double-digit. Can't do $1 trillion, but we can do an awful lot in a $50 trillion credit market.
Okay, we're just checking here. Ilfryn, what about yourself?
Yeah, I think a lot of good points have been made. I would say the one that's interesting is scale. And so we'll all laugh a little bit about trying to do $1 trillion at 7-8% or whatever the numbers are. But it's a very real issue for building any of these businesses, is how do you build them so that they can scale? Because it really is, and I love Lawrence's description of it. It's a business, it's not a fund. And so a lot of these spaces really require infrastructure, not just to do them well, but to deliver scale. I think one place we haven't spoken about is the consumer and lending to the consumer. And one place we've seen an awful lot of bank retrenchment is in lending to consumers. And so something that we've done a lot in is buying that infrastructure off traditional lenders who are exiting that business and looking at that as a scalable and pre-built platform for delivering those sorts of returns.
Pierre?
Sure. So I think we share some of the same concern around pricing, specifically in CCC. However, I think we still find idiosyncratic opportunities which we believe make sense and help us deliver that performance. One of the themes which for us, I think, has been very interesting in Europe is around that earning improvement potential. And I think we have a slide 7, I think, which speaks to that. If you look at PE valuation in the US and Europe, they look pretty high and elevated and similar. However, we don't think it gives you the full picture. What's interesting, if you look at the share equity price performance in Europe versus the US since 2007, is you'll see the US equity performance is driven 2/3 by earnings improvement and 1/3 by multiple expansion. If you then look at Europe, Europe is driven over 100% by multiple expansion. Said it another way, European earnings today are still 40% below where they were in 2007, whereas I think in the US, they're 35% above. So if you can identify those companies that in an improving economic backdrop will see a material repricing of their, re-rating of their earnings, I think there's a real repricing opportunity, specifically in distress. So I think we continue to find selective distress opportunity, which we think are very attractive. And I'll give you just one quick example. It's a Greek company, Chillaz, third largest Greek telco operator. It's a business that was sold in 2007 for $3.5 billion, 3.5 billion euros. At the time, EBITDA was 450 million euros. It went then through 2 rounds of restructuring, and we're buying it in second part of 15 on the basis of 1/10 of the valuation of 2007. So why was it so cheap? I think the earnings were no longer 450 million. It was 80 million euros and trending lower. They also had debt maturities that were coming due, and it was unclear how they're going to refinance, and they needed a bit more equity to fund the capex. So, we've taken that over. We changed the board, improved governance. We've helped refinance the debt maturities. We put a bit more equity. We believe today that business is probably worth 20% of what it was in 2007. We have EBITDA that's now 100 million euros and growing double digits. We're not saying we're going to go back to 450, but we think there's a lot of upside. So I think that earning theme is something where we believe we can still generate attractive returns in Europe.
Very interesting. Juan, let's go to yourself. Your firm has hundreds of people come to it who have various expectations of rates of return. How do you help them structure portfolios, invest based on those? And what role might you play with them in discussing how those portfolios are structured relative to the rates of return they're looking to achieve?
Right. I mean, the rates of return are largely driven by policy, and so that is a given. I liked your slide showing how they have been coming down. The composition of those portfolios is what has shifted more dramatically. 20 years ago, you could get the 7.5, it was 8.5%. You get that with 70% fixed income. Today, portfolios are running in the public fixed income at 24% or so. So you need to take much more risk to get to just 50 basis points lower rate of return. That has been, so the rate of return comes as a given. The portfolio, the growth in private markets is really meant to supplement that lower for longer environment and get you higher absolute returns. So one of the things that has happened in Asia specifically is that the risk premium has really gone away. And it has gone away largely in equity, and it has gone away in credit. And now when you allocate to credit in Asia, you are much more focused on absolute return than on a spread to developed markets in credit. And that is a tremendous opportunity in many ways, because I think that the explosion of different types of credit in Asia is happening in front of us. And there's more special seats, and there is more direct lending, there's more mess. And frankly, to build portfolios, as you know, you need to have options. You need to clear the market. You need to have people on the ground. You need to have options to put those components together. So if you think of that 24% in public fixed income, a big part of that is coming to private credit markets. And what we can do is essentially what we've done on the private equity piece of it, which is we'll take away from you the difficult bits so you can get to enjoy your life and the rest of it. But more importantly, we are constantly also, and that's also why we're in this panel, encouraging managers, global quality managers, to think of Asia as a much more diverse and fertile ground and build teams here. Bring the technology, bring the teams on the ground, be open to theses that, bring more onshore lending to China, not just wait on the gates for distress, and create more opportunities for the private credit parts of portfolios in Asia.
So I think we often talk about technology, but we don't really refer as much to financial technology, how to structure portfolios, how to finance a company, what's the correct way to finance a company in different countries based on industries, their future, their volatility. And so these are the challenges today of getting credit. One of the comments we heard on the panel was the one of getting local financing participation structure. So when you look at China today with more than 25 trillion deposited by Chinese nationals and Chinese financial institutions, how do we get that capital deployed in these credit markets, vehicles, private lenders structures that many of the people on the panel have made. And it's so unusual to think in the non-investment grade credit market, which makes up 99% of all the companies in the world, that they have to go to the United States to be financed, whereas Asia finances the United States government in so many different ways. And so it tells you that the potential here in Asia to create markets and to deploy the capital. In Japan alone, Japanese nationals have over 15 trillion deposited, yielding somewhere between minus and zero. So the opportunities here abound in Asia to finance the growth of Asia with Asia's capital once we have the expertise and structures to put in place. And I think one of the things we heard from the panel today is that the rule of law, financial reporting, has improved dramatically over the years in Asia. So we're now in a quick wrap-up. As we look at credit markets, I'd like to go through each of the panelists with one example of where they see opportunities. So why don't we start with yourself? Where are the opportunities?
Well, I think within Asia, I mean, we're spending a lot of time in India, both from a lending perspective and from the perspective of dealing with what is a very big NPL problem that's in its early stages of being proactively dealt with by regulators and the government. We have a slide in our presentation here about the scale of that opportunity. I think it's interesting, and if you look around the world at the conditions within which a system starts to de-lever, one of the key things has really been regulators taking a proactive stance on NPLs. And if you look at the Indian NPL opportunity, it's $150, $180 billion that needs to be dealt with in that system, and you have more proactive regulation and dealing with those cases. And so not only do you have the financing of India's growth and a lot of new lending opportunities, you have the opportunity to participate in the restructuring of that system and what are some very big companies as well. And so we're spending a lot of time on that.
Pierre?
Well, I think given what we said about the complicated market and the pricing environments, I think we want to be defensively positioned. I think we want to avoid market risk, and we want to focus on idiosyncratic and event-driven ideas.
Juan?
As I said earlier, there's too much capital in distress for Asia, and beware of mezzanine positions in Asia. We've tried to avoid it successfully, all of them. Funny enough, a combination of direct lending and absolute return special seats structuring. We've liked the promoter refinance in India, for example. We can get good collateral and good absolute returns would be our ideal portfolio at the moment.
Lawrence?
I think the opportunity is to lower your return expectations and rotate out of junior debt, rotate out of subordinated debt and second lien where your returns are likely to be flattish, and accept the not ideal but still attractive returns in senior secured floating rate debt.
And what rates of return, if they came to you, would you expect to get with, I'm assuming, some degree of leverage?
In our core funds where we use 2-to-1 leverage, we expect over the next 5 years to earn between 11 and 12%. That's assuming the forward LIBOR curve. But somebody who's targeting 15%, we're not going to hit 15%. And somebody who's trying to get 15%, I don't think is going to get 15%.
Right. Well, I think if we asked the 20 trillion in the room how many are willing to accept 11%, pretty much everyone will raise their hand.
Yeah.
So, from that standpoint. Rob?
I just close with a theme that I heard across the group, but I share very much so. Replacing the banks in Asia, buying into, at your prices, at the top of the capital structure, replacing the banks and buying those bank loans, because the banking system...
At the top of the capital structure.
Top of the cap structure.
Senior debt.
Senior debt, top of the cap structure. I share the don't do the mezz in Asia play. Top of the cap structure, restructurings, buying from the banks at the top of the cap structure is real opportunities because the banking system is retrenching, much as it did in the US and Europe 5-7 years ago, or replacing the banks and come in and do direct lending and participate in company builds as the non-bank lending companies really replace the banks. Both of those are pretty exciting, long opportunities.
So, taking you back almost 50 years, the goal when I went to Wall Street was, could we democratize capital by creating thousands of potential investors taking the pressure off the banking system and the reliance of countries on the strength of a handful of financial institutions. And the 5 panelists today have given you the roadmap of how to get there, not just in the United States, but throughout the world. Thank you very much for joining us today.
Thank you very much.